My base case is Bitcoin goes to 13 million a coin, and it's the ARR of 29% ARR over 21 years.
Saylor's base investment assumption is that Bitcoin will provide a 29% ARR for 21 years, which he treats as the baseline performance against which all other investments must be measured. This rate of return, according to him, acts as a risk-free benchmark for deciding whether to invest in anything else. He highlights that traditional corporate bonds, startup ventures, or even well-regulated financial institutions cannot match Bitcoin's potential without excessive risk. For example, a startup would need to offer at least a 40% annual return to compensate for its higher risk profile, which makes most such opportunities unappealing to him. Saylor underscores that the only thing better than Bitcoin is more Bitcoin, dismissing other ventures, whether hardware wallets, Bitcoin custody services, or lending platforms, as distractions from this core strategy. His view is that owning Bitcoin directly offers the simplest and most powerful way to build wealth over time.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
My base case is the risk-free return is 29% ARR for 21 years, which means that when you pitch me an idea, if you come to me and say, hey, I got a new Bitcoin custody thing, or I got a new hardware wallet, or I got, a new Bitcoin whatever banking thing, or I got a new whatever. I'm like, well, so can you guarantee me 29% plus the risk premium, which is probably 8%, 6, 8, 10%. It's like the risk premium on a mega corporation like Disney or whatever is 4 or 5%. And the risk premium on a small startup has got to be 20%. Okay. And so if you pitched me an idea and said, okay, I guarantee you 40% ARR for the next 21 years. And I'm like, and is it going to be capital free? Like I don't have to bother with it and I don't have to put any more money in later. You're like, well, if you promised me all that stuff, I was like, okay, well, let me think about it. But probably if you gave me 10 of those ideas, I probably still don't want them because it's just a distraction, because my view is 29% ARR risk-free. And then I guess I would say, when you look at it like that and you compare it to the next 50,000 publicly traded company ideas and the next 500 million private ideas, it's like they're all kind of distractions with the exception of this, which is the only thing that's better than Bitcoin is more Bitcoin. Okay, so what is my personal idea? My personal view is like my personal holding strategy is I own Bitcoin. I'll either hold the asset, 17,732 Bitcoin, which I tweeted, 4 years ago, which I'm still holding. Or I would hold like the ETF if I needed to, to buy, if I had extra cash flow yesterday and I just wanted to have it. And I thought, well, I don't know if I can hold it for a decade. I might need to spend it in 2 years to pay some expenses, but I'm going to hold it for now. So if I'm trading in high frequency in and out or whatever, it's like, I would buy an ETF of Bitcoin and I would take the counterparty risk to BlackRock or Fidelity or something. But, would I put my Bitcoin with Celsius, or BlockFi or FTX or Genesis?
Long list.
They all pitched me, by the way. I already said no to every one of them. No. But why? Because the counterparty risk to an unregulated entrepreneurial custodian is like 25% a year. Like they're going to fail every 3 years, right? So, I mean, just rationally thinking, and I just don't need the headache. So if you offered me 40%, I mean, think about this, right? If you thought you've got 25% counterparty risk and your risk-free rate is 29% over 21 years, you're already up to the point where they have to offer you 55% interest to put your money in their custodian, right? So did any of them offer me 55% interest? No. And by the way, if they did, then my next question is, well, how are you going to generate 55% interest? Well, we're going to put it in a DeFi levered protocol on what? I'm like, okay, well, no. Now I've got towers of counterparty risk. That's 7 layers of risk. And eventually there's a degenerate trader, offshore in a dark pool that's levered up 20-1 that's paying that. So none of those things are very compelling. So I would say those don't make any sense.
Saylor outlines his personal Bitcoin strategy. He aims to hold Bitcoin indefinitely. His core holdings include the 17,732 BTC he disclosed 4 years ago, and he remains committed to keeping them. If liquidity needs arise, such as future expenses, he would consider temporarily using Bitcoin ETF rather than selling his Bitcoin outright. This approach minimizes his tax exposure and gives him more flexibility. Unlike traditional trading strategies, Saylor focuses on long-term value accumulation rather than short-term gains. His investment philosophy reflects a deep conviction that Bitcoin is a once-in-a-generation asset with no equivalent alternatives in the financial world.
Look, if the accounting is prejudicial, and if the regulator is prejudiced, and if the banks are unwilling to do business with you, those 3 things are just showstoppers, right? We haven't even got to the question of what's my allocation, right? So I think that the allocation is 0 for if you say to a corporation, you're only going to lose money on an accounting basis, you'll never make money, the allocation is 0. If you say to an institutional investor that trades on the New York Stock Exchange or trades in the US and they're regulated, and you say you can buy it via IBIT or via FBTC using with a call to Morgan Stanley or JP Morgan, then the allocation might be something. But if you say you have to set up an account on FTX or Binance or offshore, or even on Coinbase, well, I mean, the allocation is probably nothing, right? It's probably 0. So this is a 0 to 1. So I think those first 3 things are what's possible for the asset to come to life. After you have those things, then there's a discussion of, well, what's the volatility? What's the performance? What's the Sharpe ratio? What's the duration? What's the holding period? What's the risk? And then what's the communication strategy? And so I think that this education, it's pretty important for individuals. What we've been doing has been important for individuals. It's pretty important for family offices, especially forward-thinking ones. For private companies, maybe they could do something. But if you ask, who are the most conservative movers in the universe? Well, the second most conservative would be operating companies that are publicly traded, right? That are disclosing everything they do every quarter and regulated. And the most conservative are the banks, public companies that are actually regulated custodians of other people's assets. So the fact that we've worked our way from individuals to high net worth individuals to private companies up to, the tech innovators, and now we're working on the mega public corps and the banks, right? That's a sign of the asset improving, and education matters. Setting an example matters, right? But there's just a lot of moving parts here, and we're talking about the birth of an asset class and a paradigm shift. And in both cases, right, it's like an organic viral process It's like, which is, they say, one of the first things they taught me at MIT about this was, they said, if you have a pond and there's algae in the pond and the algae is doubling every day, and in 30 days, it covers the entire pond, on what day of the month will you notice you even have any algae? And it's like, well, 90% of the days, you don't even know you have any. And like on the 26th day, you notice something. And then in 3 more days, the pond's completely covered, right? So with exponential processes, there's a whole lot of nothing apparently going on as the process builds and builds. And all of a sudden, there's a little blip. And then all of a sudden, you have more action, right? Like with Apple stock, right? It took forever, 40 years to make it to $1 trillion, and it took like 18 months to make it to $2 trillion. It's like, but you see that as a phenomenon, and that's the phenomena here, organically, virally spreading everywhere in the world, I think. If you have a large holding of an ETF, you don't necessarily have the optionality to move your holding to a different ETF provider without taking a tax hit, right? Without a taxable event, right? This is why cash creates and redemptions are much less efficient than in-kind create and redemption. If you had an in-kind create and redemption, you could actually take a redemption without a taxable event in Bitcoin, move it to another ETF provider, and then swap that for shares without a redemption. So being able to relocate your asset between various counterparties and various custodians in various places without a taxable event is very important.
Michael Saylor's investment philosophy is rooted in the belief that Bitcoin represents the ultimate store of value, capable of delivering 29% annual returns over 21 years. His analysis dismisses most competing investment ideas as distractions, given Bitcoin's unique advantages in security, liquidity, and counterparty risk minimization. For Saylor, the only viable strategy is accumulating and holding Bitcoin for the long term, while cautiously leveraging ETF for short-term liquidity when needed. As institutional adoption gradually progresses, Saylor envisions Bitcoin becoming a core component of financial markets. He encourages investors to adopt a patient, long-term mindset, recognizing that Bitcoin's growth will follow an exponential path, slow at first but unstoppable once critical mass is reached.
Please like and subscribe my channel.